For decades, real estate has been sold as the safest investment you can make, a place to park your money, a hedge against inflation, something you can always rely on. But what if the real danger isn't a sudden crash? And what if the people who think they're the safest are actually the most exposed? In this video, you'll learn how real estate actually fails across an entire cycle, not through headlines and crashes, but through leverage, liquidity, and time. You'll see why some investors survive downturns while others get trapped, and how the same asset can destroy wealth for one group while transferring it to another. Because here's the first thing that needs to be said clearly. Real estate is not a single asset. It's a structure. This is where most people already misunderstand what they own. When people say, "I own real estate," they're often talking about completely different things while using the same word. A primary residence bought with cash behaves nothing like an office building financed with short-term debt. A rental apartment in a growing city behaves nothing like undeveloped land. And farmland behaves nothing like urban property. Lumping all of this together under one comforting label is how analysis breaks down. So before we talk about whether real estate can preserve wealth, we need to separate what we're actually talking about. There's residential real estate, where value depends on household income, employment stability, demographics, and affordability. There's commercial real estate, where value depends on business activity, credit availability, refinancing conditions, and occupancy. And then there is land, which is often ignored in these conversations, even though it plays a very different role. Land can be arable farmland tied to food production and agricultural economics. It can be forest land tied to timber, carbon credits, or long-term resource value. Or it can be undeveloped land held purely for optionality. Unlike buildings, land does not depreciate physically, but it is still deeply exposed to regulation, taxation, and liquidity constraints. Each of these categories reacts differently in a crisis. Treating them as one is the first analytical mistake most investors make. And this is where false confidence starts to creep in. The second mistake is ignoring how the asset was acquired. Real estate bought with accumulated savings behaves very differently from real estate bought with leverage. Credit transforms real estate from a passive store of value into an active financial obligation. Monthly payments, refinancing risk, interest rate exposure, these don't disappear in a crisis. They intensify. And this distinction is absolutely critical in the current environment. For most of the last 20 to 30 years, real estate benefited from a very specific macro backdrop: declining interest rates, expanding credit, stable globalization, predictable policy. In that world, leverage wasn't just manageable, it was rewarded. But wealth preservation in a crisis is not about what worked in expansion. It's about what survives contraction. Which brings us to a necessary pause. This is the point where most strategies quietly break. Before we even debate whether real estate is good or bad, we need to define what we mean by wealth preservation. Because this is where most discussions quietly go off the rails. Preserving wealth does not mean maximizing return. It does not mean generating yield at all costs. And it does not mean owning something that feels familiar. Wealth preservation means three things, and only three things. First, liquidity, the ability to access value when conditions change. Second, control, the ability to make decisions without being forced by external pressure. Third, optionality, the ability to act when others can't. Every asset that claims to preserve wealth must be tested against these criteria, especially in a systemic crisis. So now let's apply that lens to real estate, calmly, without ideology. This is where the emotional story people tell themselves starts to fall apart. Real estate feels safe because it's tangible. You can touch it, you can see it, you don't see its price moving every day on a screen. That psychological stability is powerful, but psychological comfort is not the same thing as financial resilience. In a crisis, what matters is not whether an asset looks stable, but whether it is stable under stress. Real estate, by its nature, is illiquid. That's not a flaw, it's a feature in normal times. But in a crisis, illiquidity becomes a cost. You cannot sell quickly without discounts. You cannot rebalance easily. You cannot react to changing conditions without friction. Now add leverage to that picture, and the equation changes dramatically. If an asset produces stable cash flow, leverage can enhance returns. But if cash flow weakens, leverage doesn't just reduce returns. It introduces risk of loss of control, refinancing risk, forced sales, capital injections at the worst possible moment. This is not theory. It's how real estate cycles break. And this is where the current macro context matters more than ever. We are entering a period defined by higher interest rates, tighter credit, rising public debt, and increasing policy unpredictability. Commercial real estate is already under pressure from structural shifts like remote work and changing consumption patterns. Residential real estate is increasingly constrained by affordability and employment uncertainty. And land, while often perceived as pure value, is deeply exposed to regulation, taxes, zoning rules, and long holding periods without income. None of these realities automatically make real estate a bad investment, but they do mean that real estate is not a universal safe haven, especially not by default. And this is why timing matters more than belief. The real question is not whether real estate can ever preserve wealth. The real question is under what conditions, in what form, and at what moment in the cycle it does so. And that is exactly where we're going next. Because once we understand what real estate actually is and what wealth preservation actually requires, we can finally talk honestly about where real estate still works and where it quietly stops working. In the current environment, now that we've clarified what real estate actually is and what wealth preservation really means, we can finally do the uncomfortable part. We can test real estate against reality, not nostalgia. Because real estate does have advantages, real ones. Ignoring them would be dishonest. But those advantages only work under very specific conditions, and most people assume those conditions are permanent. They're not. Let's start with the strongest possible case for real estate, because if it fails even there, everything else becomes obvious. If you own real estate outright, with no debt, no refinancing risk, and no forced obligations, you remove the single biggest structural weakness of the asset: leverage. In that scenario, real estate is no longer a financial instrument tied to the credit cycle. It becomes a productive asset. A fully paid property does not face margin calls. It does not care if interest rates double. It does not get a call from the bank asking for new terms. That alone makes it fundamentally different from leveraged real estate. In an inflationary environment, a cash-owned property can partially protect purchasing power, especially if rents can adjust upward over time. This is one of the reasons real estate performed well in certain historical periods. Rising prices eventually translated into higher nominal rents, and owners without debt benefited. The key word here is eventually. Rental income is not automatic. It depends on tenants having jobs, businesses surviving, and demand remaining intact. In a slowdown or recession, even inflationary ones, rent growth can stall or reverse, especially when affordability becomes a political and social issue. This is where many people confuse yield with preservation. Cash flow feels like safety, but cash flow that depends on economic health is not guaranteed. In a systemic downturn, tenants disappear before buildings do. Now let's extend this analysis to land, because land is often brought up as the purest form of real estate. Arable land has historically been viewed as a store of value because it produces food, and food is essential. That argument has merit. People will always eat. But agricultural land is not immune to macro forces. It depends on commodity prices, subsidies, weather patterns, labor availability, and regulation. In times of crisis, governments intervene heavily in agriculture. Price controls, export restrictions, tax changes, and land use rules are not theoretical risks. They are historically common responses. Owning land does not mean owning full economic freedom over that land. Forest land, timberland, or other resource-based land introduces similar complexities. While the asset itself may be long-lived, monetization depends on demand cycles, environmental regulation, and capital intensity. And just like buildings, land is extremely illiquid. You cannot quickly convert it into optionality when conditions change. Undeveloped land held for optionality is even more challenging. It produces no income, requires ongoing taxes and maintenance, and its value is entirely dependent on future development potential, which is often the first thing delayed or canceled in a crisis. So even in the best case versions of real estate, the advantages are conditional, slow-moving, and heavily dependent on external factors. Now let's talk about the other side of the equation, because this is where the current context becomes unavoidable. Most investment real estate today is not bought with cash. It is bought with leverage. And leverage is not a detail. It is the core risk. For years, real estate investors operated in a world where refinancing was routine. Rates went down or stayed low. Credit was abundant. Banks competed for borrowers. In that environment, leverage felt safe. That environment no longer exists. Interest rates are materially higher. Credit standards are tighter. Banks are under pressure from regulators and balance sheet constraints. Refinancing is no longer automatic. It is a negotiation and sometimes a rejection. This is particularly dangerous for commercial real estate, where large volumes of debt are maturing over the next few years at rates that are dramatically higher than when the loans were originated. Even properties that are performing well on paper can become distressed simply because the math no longer works. Vacancy rates in office and retail are already elevated. Remote work is not a temporary shock. It is a structural shift. AI and automation further reduce the need for physical space in many industries. That means demand is not just cyclical, it is changing. When you combine higher vacancies with higher interest costs, cash flow compression becomes inevitable. And when cash flow compresses, leverage turns from an amplifier of returns into an accelerant of losses. Residential real estate is not immune to this dynamic either. Affordability is already stretched. Household debt is high. Wage growth is uncertain. If unemployment rises or job security weakens, rental demand becomes fragile. Political pressure for rent controls or tenant protections increases. That directly impacts the owner's ability to adjust income. And unlike financial assets, real estate owners cannot easily exit or rebalance. You cannot sell 10% of a building to reduce risk. You either own it or you don't. That binary nature becomes a liability in volatile environments. Liquidity is the next major issue, and it's one that almost never gets discussed honestly. Real estate is illiquid by design. In normal markets, that's acceptable. In stressed markets, it becomes dangerous. When everyone wants to sell, buyers disappear. Prices don't adjust smoothly. They gap down through forced transactions. The illusion of price stability in real estate is just that, an illusion. Prices don't move daily, but value erodes through time, financing costs, and missed opportunities. While someone waits months or years to sell a property, their capital is trapped. They cannot deploy it into distressed opportunities. They cannot respond to policy changes. They cannot protect themselves dynamically. This is the opposite of wealth preservation, as we defined it earlier. Now add government and policy risk to this picture. In times of fiscal stress, governments look for immobile tax bases. Real estate is the most immobile asset there is. Property taxes rise, regulations tighten, land use rules change, rent controls are introduced or expanded. These are not extreme scenarios, they are common historical responses. At the same time, public debt levels are historically high, not just in the United States, but globally. Servicing that debt becomes harder in slower growth environments. That pressure does not disappear. It gets transferred. Real estate owners are easy to find, easy to tax, and hard to move. That makes them politically convenient. This is why real estate often performs worst, not at the peak of the crisis, but in the slow grind afterward, when policies shift and capital remains constrained. Now step back and look at the full picture. Real estate can preserve wealth under specific conditions: low leverage, stable income, predictable policy, ample liquidity elsewhere in the system. But the current environment is defined by the opposite: higher rates, tighter credit, structural changes in how people work and consume, rising public debt, policy uncertainty. That doesn't mean real estate is dead. It means its role has shifted. Real estate is not a first-line defensive asset in a systemic crisis. It is a slow, capital-intensive business that performs best after repricing, not before it. The mistake most investors make is entering real estate for safety at the exact moment when flexibility matters most. And this is the core takeaway of this section. Real estate does not fail loudly. It fails quietly, through refinancing stress, through declining cash flow, through lost optionality, through being stuck when others are moving. In the next part, the question becomes even more interesting. If real estate is not the primary tool for preserving wealth right now, then what is? And how do you position yourself so that real estate becomes an opportunity later instead of a trap today? That's where this conversation is heading. At this point, the picture should be much clearer, even if it's uncomfortable. Real estate is not failing because buildings stopped existing. It's failing as a default strategy because the conditions that made it feel safe no longer line up with the reality we're entering. For years, real estate benefited from a perfect storm in the positive sense. Cheap money, easy refinancing, growing economies, predictable policy. In that environment, even mediocre decisions looked smart. Leverage was rewarded, illiquidity was ignored, and long-term risks were masked by rising prices. But wealth preservation is not about what works in expansion. It's about what survives contraction. And in contraction, the rules change. What we've seen is that real estate is not a single answer. It's a slow-moving, capital-intensive business that demands stability in order to perform well. When stability disappears, its weaknesses become impossible to ignore. Illiquidity becomes a cost. Leverage becomes a threat. Cash flow becomes fragile. Policy becomes intrusive. None of these show up on a Zillow chart. None of these feel dramatic in the beginning. But together, they quietly erode control. That's the key word here, control. In a crisis, the most valuable asset you can have is not yield, not appreciation, not even income. It's control over your decisions. Real estate doesn't protect you from the cycle. It takes control away when control matters most. The ability to wait, the ability to move, the ability to act when others are forced to react. Real estate, especially leveraged real estate, takes that control away at the exact moment you need it most. This is why real estate tends to become attractive after crises, not before them. After repricing, after distress, after forced sellers have exited, that's when capital-rich investors step in. Not because they love buildings, but because they have liquidity, patience, and negotiating power. The tragedy is that many people lock themselves into real estate too early, under the illusion of safety, and then miss the actual opportunity when it finally arrives. This doesn't mean real estate has no place. It means timing matters more than ever. Cash-bought assets with no debt can survive, but they still suffer from illiquidity and policy risk. Land can hold value over long horizons. but it ties up capital and depends heavily on regulation. Commercial property faces structural shifts that go beyond the cycle itself. Residential property is constrained by affordability, employment, and politics. None of these are reasons to panic. They are reasons to be precise. The biggest mistake investors make in moments like this is thinking in binaries. Real estate, good or bad. Buy or sell. All in or all out. That's not how professionals think. Professionals think in phases. In early stress, they protect liquidity. In deep stress, they preserve optionality. In aftermath, they deploy capital into distress. Real estate fits best in the last phase, not the first. And that's the reframe that matters. Real estate is not a shield. It's a tool, a powerful one, but only when used at the right moment. If you already own real estate, this isn't a call to fear. It's a call to awareness, to understand your exposure, your leverage, your refinancing risk, and your dependency on policy and tenants. If you're considering entering real estate now for safety, this is a warning. Safety is not about familiarity. It's about resilience under stress. Crises don't reward comfort. They reward preparation. And preparation means being honest about what an asset can and cannot do in the environment you actually facing, not the one you wish would return. The investors who preserve and grow wealth through crises are not the ones who cling to old playbooks. They're the ones who adapt before the pressure forces adaptation on them. Real estate will have its moment again. It always does. But this is not that moment. This moment is about staying liquid, staying flexible, and staying in control so that when the dust settles and others are selling out of necessity, you're buying by choice. That is the difference between surviving a crisis and being shaped by it. And if you understand that now, you're already ahead of most people who won't realize it until it's too late. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.